Hey tech-savvy listeners, welcome to the Tuesday edition of Tech Stocks Daily, where we're diving into today's juiciest tech news straight from the NASDAQ charts. Buckle up as we unpack Supermicro's thrilling saga of options trades and a ticking earnings call. Delve into Shopify's bold ethical stance against hate speech while celebrating soaring revenue, and navigate Meta's stock drama amid juicy analyst predictions. Pinterest also shakes things up with a stock market comeback that's got investors buzzing over double EPS growth. Stay tuned as we break down the headlines that could shape your investment strategies. Let's jump in. Welcome tech aficionados to the scoop on today's spicy highlight, Supermicro sizzling on the NASDAQ grill under the symbol SMCI. If you're anywhere in proximity to the tech orbit, you must have caught the whiff of intrigue surrounding SMCI in today's financial news. So, what's cooking? We've got an intriguing mix of options activity and accounting drama, a true tech stock soap opera. First, let's talk about the unusual options activity that caught everyone's attention. Cranking up the heat, Benzinga's options scanner unveiled an astounding 106 uncommon options trades for Supermicro. We've got serious players on board. Whether they're big shot institutions or mega-rich individuals remains to be seen. The sentiment among these hefty traders is anything but dull. It's a bold 42% bullish and 42% bearish divide. They're in with a staggering $5,870,049 in calls and $1,704,449 in puts. The sheer volume speaks volumes, hinting that folks suspect something colossal is simmering beneath the surface for SMCI. Now on to the juicy gossip. SMCI stock, which slipped by nearly 4% in pre-market trading. The plot twist? Investors are holding their breath for today's second quarter earnings call. Here's where the suspense kicks in. They're waiting eagerly for updates on SMCI's delayed filing of the annual report for the fiscal year ending June 2024. Talk about a cliffhanger. The NASDAQ has graciously extended SMCI's deadline for this 10K filing until February 25th. But here's where it gets nail-biting. As if we didn't already have enough drama, the company risks the NASDAQ acts of delisting if they miss this deadline. And why this debacle in governance, you ask? It harkens back to perfectly palpable July, when their former auditor Ernst & Young flagged concerns about SMCI's internal controls over financial reporting. Spurred on by these alarms, the board put together a special committee to investigate. Fast forward through a couple of seasons, and in December, the special committee found no material substance backing EY's concerns. Phew. But in their tangled web, investors demand reassurances about the company's transparency and governance practices. All eyes are on SMCI like it's a high-stakes tech thriller. Wedbush analyst Matt Bryson has pointed out some substantial unknowns that could cast a shadow over Supermicro's stock's near future. Competitive giants like HP Enterprise winning AI server contracts adds another layer to the drama, raising the stakes even higher. However, amidst these swirling clouds, there's an analyst glimmer, and that's Loop Capital Markets' Ananda Barua, keeping the prophecy upbeat and calling SMCI an important company in an important space. In conclusion, today's attention on Supermicro is a delicious mix of speculative spice from unusual options activity and chilling suspense with its financial filing jeopardy. Whether the story will conclude with a share price uptick or a dramatic delisting denouement, we're all keen to tune in next. Tech suits, grab your popcorn, because this won't be a narrative to overlook. Stay tuned for more. Today, Shopify made a splash in the tech news world for a couple of contrasting reasons that put the company both in a societal hot seat and a corporate limelight. First, let's talk about the stormy part of the news. Shopify's decision to take down a controversial website linked to rapper Ye, formerly known as Kanye West. Ye had managed to attract unwanted attention with a Super Bowl advertisement for his Yeezy website, which was promoting swastika-themed t-shirts. Yes, you heard that right, a swastika shirt, as mind-bendingly unsuitable as that sounds. Following its debut during one of the most viewed TV events in America, the site stayed up until Shopify pulled the plug on Tuesday, citing a breach of its terms of service. Shopify's president, Harley Finkelstein, didn't mince words in expressing his dismay. As a proud Jewish entrepreneur, he openly communicated his personal and professional devastation over the episode. Shopify reportedly gave the site owners a chance to prove they weren't violating policies, which apparently didn't pan out. Soon after, the site was off Shopify's platform. This act stands as a stern reminder of Shopify's zero tolerance toward hate speech and offensive content, which aligns with broader societal values and ethical e-commerce practices. Switching gears to the corporate side, Shopify delivered an earnings report that was a veritable fireworks show of positive numbers. The e-commerce giant saw its revenue surge 31% to $2.81 billion for the fourth quarter of 2024, besting analyst expectations. That's 7 quarters in a row with revenue growth north of 25%, and the shareholders surely aren't complaining. The company's gross merchandise volume also soared, reaching a staggering $94.5 billion, marking a 25.7% increase from the previous year. Additionally, Shopify's engine of growth, namely its merchant solutions, saw revenue increase by an astonishing 32.6% year over year. Not to mention, their net income almost doubled from last year's $657 million to a cool $1.29 billion. Talk about making it rain. For the future, Shopify forecasts revenue growth in the mid-20% range for Q1 2025, coupled with a solid free cash flow margin expected in the mid-teens. That sort of financial optimism has led Wall Street to not only raise their eyebrows, but their price targets for the stock as well. So there you have it, folks. Shopify showing two very different sides of the coin today. On one hand, demonstrating a corporate commitment to ethical business practices by shutting down hate-fueled commerce, and on the other, flexing its financial muscles with a robust earnings report. Whether navigating the murky waters of controversial content or steering its financial ship to clearer skies, Shopify remains an undeniably impactful player in the tech and business world. Hey tech enthusiasts, let's dive into today's spotlight on Meta Platforms, the NASDAQ giant behind the familiar lineup of Facebook, Instagram, Messenger, and WhatsApp. As the world's largest social media company, Meta is making waves on the stock market like always, but there are some spicy developments we can't overlook. First up, we had some fresh insights from analysts comparing Meta's place in the interactive media and services industry against its competitors. Spoiler alert, Meta's fattening wallet and user base are seemingly wearing sunglasses because they continue to outshine. Despite a more modest price-to-earnings ratio, suggesting that it's undervalued compared to its industry peers, the hefty price-to-book and price-to-sales ratios might make you squint a bit. It's like wearing one of those fancy overpriced watches, totally worth it for some, meh for others. The numbers are juicy. A whopping $39.55 billion gross profit and a revenue growth of 20.63%, well above the industry baseline. But wait, not everything is all rainbows and AR goggles for Meta. We dove into the gluier realm of options trading, and boy, are investors flexing some moves. Benzinga unveiled a pretty bearish sentiment among some of the big-weight investors lately, which is unusual enough to raise eyebrows, if not a few stock prices. We're talking about out-of-the-ordinary options activity with 11 massive trades. Now here's where it gets juicy. The betting is largely split. 36% are feeling bullish, but a hefty 54% are hedging their bets downwards. That's like a skeptical friend at karaoke night, betting you can't hit the high notes. The big hitters are eyeing a price range between $600 to $730, keeping things interesting and perhaps a little tense for Meta observers. And finally, we're seeing a scattershot of analyst ratings. They've pegged Meta with a target price dartboard range that's decidedly optimistic, from BMO Capital's cautious $610 to Rosenblatt's sky-high projection at $846. Not to mention, a buy rating from big names like UBS and Truist Securities keeps the spotlight firmly on the social media behemoth. To wrap it up, Meta's showing off some rock-solid numbers despite the bears lurking in the options jungle. Whether investors are shivering with anticipation or concern, the financially savvy are keeping their eyes on the horizon and consolidating their insights via Meta's unwavering market presence. Don't head off trading alone without those insider tracks. Holding your financial compass should guide those investment sailings smoothly. Stay steady, tech investors. Meta, much like your uncle at Thanksgiving talks, isn't leaving the table anytime soon. All right, folks, let's dive into why Pinterest is grabbing headlines today. It's like the tech version of a juicy celebrity sighting, but without the pap snaps and red carpets. Pinterest, the famous digital pinboard tailored to let us save everything from dream house decor to mouth-watering recipes, has been doing quite a tango on the stock market, returning a nifty 30.4% over the past month. Compare that jazz to the modest shimmy of plus 4.2% by the Zacks S&P 500 composite, and you see why Pinterest is suddenly the talk of the town. But hold your digital horses before you get too giddy. There's more to this story than a meteoric stock rise. It's all about those earnings projections, folks. A hot ticket in the world of stocks. Zacks, the guardian angels of stock ranking and analysis, have thrown Pinterest into their system, scrutinizing how analysts are adjusting earnings estimates. A significant move can make an investor want to shout, buy, similar to finding out your favorite show just got renewed, and you simply can't resist holding on for more juicy episodes. Pinterest is scaling up in the earnings game for the current quarter with a projected EPS of 23 cents, marking a spiffy 15% leap from last year's numbers. However, there's a twist. A reduction in the Zacks consensus estimate by 12.9% over the past 30 days. Sounds like they're riding an earnings roller coaster, right? Zooming out, Pinterest's earnings estimate for the fiscal year clocks in at $1.76, implying a sagacious jump of 36.4% year over year, a number every CEO dreams of marking on their report card. And they aren't stopping there. Next fiscal year's estimate at $2.06 pins even more growth, like saving ideas to create a vision board of profits. Even with these numbers lining up like ducks in a row, Pinterest finds itself at Zacks rank number 3, suggesting it may strut alongside the broader market trend for now. Not the spotlight-stealing superstar performance, but not shabby either. Their chic twin forces of revenue growth and prosperous earnings can't perform solo forever. They accompany each other like milk and cookies. Revenue projections also deserve a bow, with a current quarter estimate showing a sparkling 14.4% year-over-year change. The digital aisles of Pinterest are evidently stocked well beyond its user pin frenzy. Still, all that glitters? Zacks Valor style gives Pinterest a grade D, hinting the world is pegging the stock slightly high. Basically, if Pinterest was an item on your board, you might weigh out whether it really deserves that premier status compared to its peer pins. Now, turning the mic over to you. What do you think of Pinterest's current journey on the stock carousel? Slick moves or skating on thin ice? Share your thoughts in the comments because, just like Pinterest boards, this show thrives on what you pin up and share. Time to sign off and collect those thoughts like well-placed pins. Can't wait to hear from you legends out there. All right, let's put the spotlight on Shopify for today's stock pick chat. Shopify has had a roller coaster day, balancing ethics in the off-field headline with powerhouse numbers in their earnings report. Both facets offer us unique perspectives on whether to sell, buy, or hold. Let's break it down. Today saw Shopify making a stand against an ethics breach with decisive action. It's like watching a CEO take the moral high ground at a business conference. This kind of bold stance speaks volumes, reinforcing a positive company image and instilling investor confidence by aligning corporate values with societal expectations. Now, onto the earnings juggernaut. Shopify's revenue went through the roof, a cool 31% year-over-year increase to $2.81 billion in Q4 2024. That's the kind of growth that would make any investor's wallet do a happy dance. With gross merchandise volume also shooting up and merchant solutions showing robust contributions, Shopify proves it's not just here for a good time, but a long, prosperous time. Their continued success in driving revenue and income growth gives off major buy vibes, as the company keeps exceeding expectations quarter over quarter. However, keep in mind, while financial optimism shines through their stellar earnings report, investors are urged to stay vigilant about broader tech fluctuations and macroeconomic challenges that can always tweak the narrative. So with all these sparkling factors in mind, if it were up to me, I'd be leaning towards a solid buy recommendation on Shopify. They've got compelling numbers, strong ethical stances, and they're actively winning over Wall Street with growth projections that scream potential. Yet before you shimmy over to your stock account, dear listeners, always remember, don't just piggyback on the hype. Take time to analyze the numbers, align with your financial goals, and dissect potential risks and rewards before making any investment move. It's your hard-earned money at play, so do your research, dive into the details, and stay a smart, savvy investor. Today's tech market was a stunning roller coaster, with intriguing narratives unfolding like a blockbuster saga. From Supermicro's NASDAQ tango with their financial report drama, to Shopify's ethical stand and its financial fireworks display, we witnessed the tech world capturing headlines on multiple fronts. Meta stayed on investors' radar, flexing its untapped growth despite a smidge of bearish vibes, while Pinterest danced onto the stage with some promising financial rhythms, albeit in the shadows of a shepherd's caution. As the markets turned with speculative anticipation, notable earnings, and calls for corporate responsibility, the tech realm proved once again that it's an arena of bold moves and fast-paced developments. If you enjoyed today's rundown, give the video a thumbs up, subscribe for cutting-edge news delivered with flair, and share with fellow tech aficionados. Be sure to swing by tomorrow for another juicy slice of the tech pie. Stay curious and stay invested.